Today, we embark on a riveting journey back in time to September 2008, when the global financial landscape was shaken by the dramatic collapse of Lehman Brothers. In this 5-minute history lesson, we'll deep dive into the causes and effects of this catastrophic event that still reverberate in the annals of finance. So fasten your seatbelts as we explore the rise and fall of the mighty Lehman Brothers. From Wall Street darling to financial giant, let's rewind to the 19th century when a young immigrant from Bavaria, Henry Lehman, founded a humble dry goods store in Alabama. Little did he know that this modest enterprise would one day evolve into a Wall Street powerhouse. Fast forward to the 21st century, and Lehman Brothers had become a titan in the world of finance. With fingers in various pies, the firm excelled in investment banking, trading, and real estate. Their prominence was undeniable, and they were at the pinnacle of the financial pyramid. As the mid-2000s approached, the US housing market was in a speculative bubble. Amidst the allure of home ownership, borrowers with shaky credit history succumbed to the seductive appeal of subprime mortgages, despite their questionable ability to handle such loans. So home buyers with shaky credit were granted loans they could hardly afford. A perfect recipe for disaster was brewing, concealed by the facade of prosperity. Dubious lending practices fueled by the allure of subprime mortgages swept the nation. Lehman Brothers, blinded by the allure of immense profits, jumped headfirst into the subprime mortgage market. They packaged these high-risk mortgages into complex securities known as mortgage-backed securities and sold them to investors worldwide. Mortgage-backed securities is where Lehman Brothers gathered up a bunch of mortgages from different folks, big ones, small ones, safe ones, and riskier ones too, like a mortgage buffet. The investors watch carefully to see how the mortgages are doing. If most of the homeowners pay on time, it's like fireworks on a 4th of July. But if some homeowners start struggling to pay, it's like a rainstorm on the parade. The house of cards began to wobble by 2007. The cracks in the housing market facade were becoming evident. The subprime borrowers who were the first to jump on the homeownership ride were also the first to fall off when they couldn't afford their mortgages because the banks lent them and they borrowed more than their salary could cover. With foreclosures piling up like a mountain of sorrow, the housing market was in disarray. The supply of homes grew as desperate sellers tried to unload their properties, leading to an oversaturated market. As supply outstripped demand, housing prices began to plummet like a freefall. Homeowners watched in horror as the value of their prized assets dwindled, and for some it was like a nightmare they couldn't escape. House prices fell by between 10% to 25%, and in some cases even more across the globe during this tumultuous period. Lehman Brothers found itself holding a large number of toxic assets, mortgage-backed securities with rapidly declining value. As the losses piled up, doubts about Lehman Brothers' financial health began to surface. Rumors of their precarious position echoed through Wall Street like whispers in a crowded room. September 2008 marked a pivotal moment in financial history. As the housing market turmoil intensified, Lehman Brothers was at a crossroads. Their survival hinged on a critical decision. As their stock price plummeted and potential buyers circled like vultures, the leadership at Lehman Brothers made a bold and fateful choice. They chose to stand defiant, believing they could weather the storm on their own. They refused to seek a lifeline from the US government or other financial institutions. Lehman Brothers' final hours on September 15, 2008 led the world to watch in disbelief as Lehman Brothers filed for bankruptcy. The once proud financial giant founded over a century and a half ago was now reduced to ruins. The fallout from Lehman Brothers' collapse rippled across the globe, sparking a financial panic of epic proportions. Investors panicked, markets trembled, and financial institutions stood on the brink of collapse. The Lehman Brothers bankruptcy set off a domino effect of financial turmoil. Banks across the globe, laden with Lehman's toxic assets, faced severe liquidity crisis. Lending froze, credit markets seized up, and the world plunged into the worst financial crisis since the Great Depression. One of the primary reasons for the financial meltdown was the interconnectedness of the financial system. The toxic assets, such as the now doomed mortgage-backed securities, had spread like a contagion throughout the world's financial institutions. Banks and investment firms that once reveled in their MBS profits were now grappling with colossal losses. Governments rushed to stabilize the situation, bailing out and injecting massive stimulus packages to the likes of Merrill Lynch, AIG, RBS, Fannie Mae, and Freddie Mac, among many others, and implementing unprecedented monetary measures. The financial system teetered on the precipice of collapse. The government in the US struggled to control the crisis and decided to implement the Troubled Asset Relief Program, aka TARP, which aimed to inject hundreds of billions of dollars into the banking system to try and stabilize the financial system. The Federal Reserve also stepped in, cutting interest rates to close to zero in a desperate bid to boost economic activity. It was discovered later on that Lehman Brothers managed to hide the extent of their financial capitulation by using a little accounting magic trick called Repo 105, which essentially is shorthand for a repurchase agreement. When facing the end of a financial quarter, they'd perform a fancy dance, temporarily selling some assets in exchange for cash and therefore making their balance sheet look better than reality. After the quarter ended, like magic, they'd quickly buy back those same assets. Voila! The sly move made it seem like they had less debt and more cash than they really did, fooling everyone, including regulators and investors. The Lehman Brothers bankruptcy was a harsh wake-up call for the financial world. It exposed the flaws in the system, from risky lending practices to a lack of regulatory oversight. The consequences of unchecked greed and excessive risk-taking were laid bare for all to see. The fallout from Lehman Brothers' demise left scars that took years to heal. It forever altered the trajectory of the global economy and prompted a reassessment of financial regulations and risk management practices. Did you know Barclays paid approximately $1.75 billion to acquire various components of Lehman Brothers' North American investment banking and capital markets businesses, including trading, assets, client relationships, and some real estate holdings?